Hey guys, what's up? It's the Impeccable Investor here, and we're back on that mini series of how to value a company, how to understand if a stock is worth it, to understand the value you're getting for the price you're paying. In the first video, we discussed price to earnings ratio, which is the ratio used to determine if you're actually getting value at the price you're buying the stock at. In today's video, we're doing one of my favorite ratios, and that is the debt to equity ratio. So if you haven't already, please hit that subscribe button and turn on those alert notifications so you get notified every single time I release a new day trading or investing video. Now again, guys, we're going to get into it, and I hope you're excited, so hit that thumbs up button. Here we go. This is the debt to equity ratio. This shows you a lot of things, helps you understand the company, and is a good measure of leverage and financing in a company. Now, what exactly is debt? Debt is when you borrow money in order to purchase things, use for other assets and other things within the company. Equity is the money that the company actually has. It's the money that they own. They sold something. They now collected it after taxes, after everything. This is the money they get to keep. So this is simply a debt to equity ratio, which is dividing the debt by the equity. If we can see here, this is debt and we're dividing that by equity. So that is showing us exactly what's happening here. So this is debt divided by equity. What we're going for is, for long term, you're looking for a lower debt to equity ratio. For instance, here, the debt to equity ratio of this example is 0.5. 0.5 because it has $50,000 in debt and $100,000 in equity. When you divide it, you get 0.5. That shows that it's less than 1. Less than 1 means that the equity, the money that it has, is greater than the debt. If the number is over 1, then that means they have more debt than they have money. Now, why is this important? Well, debt is a huge thing to consider when you're analyzing a company. Why? Because a company uses money to make more money. So for instance, if they make a 20%, I don't know if y'all can see this well, if they make a 20% return on their money and they are using $100,000, then that means that year they make $20,000. Well, if they can use debt to make more money, which means they get to take on $100,000 more, so that means they have this 100 plus another 100. So that means with debt they have $200,000, but they get to make 20% still. So that means they're now making $40,000. Well, in this instance, debt is amazing because it helps them increase their profits tremendously. From $20,000 to $40,000, all they have to do is pay interest on that money they're borrowing. Well, the problem is what if they don't make money? They still have to pay this interest rate. They still have to pay back the debt, and that puts them in a negative position, a position they don't want to be in, right? If they aren't making money, they don't want to have to be paying out to people who are trying to get money from them. So a debt to equity ratio needs to make sure, this is why this is my second favorite one to watch out for. You have to make sure you understand what's happening with this company. If there's too much debt and there's a bear market and they're not able to make money as a company, then they're going to have to pay out all their money as debts and have the potential for going bankrupt. All right, guys, so as we discussed here, how we affect this is the debt to equity ratio. You want it to be low, preferably under 1, but it really just depends on the industry average. And if you hang in there, I'll give you a great example to look at. So if you see here, the way to decrease the debt to equity ratio is to do one thing here. You have to decrease debt, or you have to increase equity. So that means you either decrease the amount of money you are borrowing, or you increase the amounts of money you have. These are the two ways to affect the debt to equity ratio. Now let's look in exactly and go over a great example over how we can use this further. In this example here, this is research.tradeking.com. This is the go-to place for finding fundamentals of a company because it does all the math for you and it shows you the industry range, which is a very crucial point of understanding the value of a stock, because you need to put all these numbers into relative view of what the market is doing. So this gives you an industry range where you can compare the numbers to. So we're going to be looking at two separate companies here right now. We're going to be looking at AT&T and Verizon. We're going to start off here with AT&T. So if you can see here with AT&T, the debt to equity ratio is right here underneath financial strength, because it shows actually how much money it's paying out. It's basically the money that they have and the money that they don't have. So that's why it's under financial strength. So if you can see here, the debt to equity ratio is 105.54. So now, so you may be saying, well, Austin, the impeccable investor, whoever I want to call you, that is way over the one value that you said. That means they have way more debts than they have equity. Yes, you're so right with that. We don't want a number that high. But that's why I said we must compare it to the industry range. The industry range, it's on the low portion of this industry range, which is meaning that it's actually good. So yes, 105.54 compared to the number one that we want is a lot higher. It means that they're using a lot more debt than the actual money that they have. It is very low compared to the industry average. The industry average goes up to 569.65. Considering we're at 105.54, AT&T seems like a good buy. So now we know what the industry range is. Let's also compare it to another stock that is in the industry. So if we go up here, we can type in VC or Verizon, however you want to get to it. And we can see here, we can look at the same thing. We have a debt to equity ratio of 236.20, and that is about in the middle portion of this industry range. So looking at the debt to equity ratio, we understand we want it the lowest to be, but we also have to compare it to the overall market. So if you can see here, this is a debt to equity ratio of 238, my bad. Now, comparing this to AT&T of 105.54, it's a lot lower. It's on the lower portion of the industry range. So if we're completely valuing this off the debt to equity ratio, the buy here will be AT&T for that long-term growth. But if you can see here, if we're going to also take into consideration what we discussed in the last video, which is the price to earnings of 15.65, that is on the lower portion of the range. So if we go here, we cross that out. Whoops, my bad. If we go here and we go back to T and we start to look and bring in the price to earnings, you can see here that it also has a lower industry average of price to earnings. So now that we brought in these two ratios, we can see here that AT&T combined just on these two is the better buy over Verizon. So as you can see here, guys, this is how you pull in all the ratios together. Now, please hit that subscribe button if you haven't already. Please hit that like button if you found some value, because we're going to continue to go over some more rate ratios, the favorite ones that I think everyone should know, and then we'll make a video over combining them all into finding the best stock to invest in. All right, guys, thank you so much for watching.